Okay, good morning, ladies and gentlemen. Thank you very much for joining us here on this session. And I'm delighted. I think this is the first session on things sustainable, things clean, the shift towards the low-carbon economy, and so on here in Davos this year. Following the crisis year last year, where everybody was more interested perhaps in macroeconomics, I think what we're seeing is this whole agenda rising up the priorities. So it's nice to be kicking that off. We've got a good, strong panel here today to talk about one of the key issues around the shift to a low-carbon economy. In many ways, we have a lot of the technologies that we need, or we can at least see what those are going to look like. We know what a low-carbon energy system needs to look like. But that system, to get there, we need to be investing a figure of around $500 billion per year. There's lots of different sources come up with a similar figure, $500 billion per year in order to get there. And where we are is at about $150 billion per year. So we're about a third of the way there, and at this point, it's unclear how we're going to close that gap. So the key issue is what combination of policy, financial innovation, and so on is going to get us to be able to shift to a low-carbon and sustainable future. We've got a great panel here to talk about those issues because they pretty much cover the whole value chain. They have experience of everything from early-stage technology, investing in early-stage technologies as a limited partner. Jack Ehnes will talk about those issues later. We've got Ken Hersh, who's been financing energy for quite some time, is all I will say. You'll hear more from Ken. James Cameron, one of the world's leading experts on the carbon markets. Simon Zadek, who's a great expert on that interface between the public and the private. And Tulsi Tanti, who's been out of India, has built one of what will be one of the future colossuses of the clean energy industry. So we've got plenty of good experience up here. And I want to kick off. Really, one of the topics that's going to be top of everybody's mind here is what just happened in Copenhagen and where does it leave us? So I'm going to hand, rather than doing introductions one by one, I'm actually going to start everybody off with a question, and I think James Cameron has to be the leading candidate for that question, given his involvement in the carbon markets from their very inception and in the whole Copenhagen process. What did happen, James?
Well, thank you, Michael. I mean, it's true that I've been involved with the climate change negotiations from inception. I used to be an international lawyer and worked on the early agreements to try and build the legal structure from which you could derive an incentive to invest in the low-carbon economy, which I now do through climate change capital. And having been to pretty much every single negotiating session from 1988 onwards, this was really one of the worst. It was very badly managed. The host government did not cover itself in glory. The UN didn't seem to prepare very well for who was attending and the consequences of having many heads of state turn up at the end of the process. I mean, ideally, thinking back to 1992, when heads of state did come in quite large numbers, to sign the Framework Convention on Climate Change, which is the governing agreement within which the Kyoto Protocol sits and what would have been the Copenhagen Agreement had it been signed in the form it was intended. When the heads of state arrived in Rio, they had an agreement already signed. They already had just come and do the ceremonial stuff. They could make speeches and add some weight and power to the occasion, but they didn't have to do any negotiating. And we had plenty of time to prepare for the arrival of all these heads of state in Copenhagen, but when they came, there wasn't anything for them to agree. And in fact, worse than that, in the last stages, there were effectively 3 negotiating processes for different texts, and there was no negotiating ground upon which you could get agreement. And in fact, my belief is there was sufficient political will to get agreement in Copenhagen, and the first week you could feel it. And it unraveled because it was poorly managed and badly directed, and there wasn't sufficient clarity about what it is that could be agreed multilaterally. However, what I see emerging from a disappointing outcome from a European perspective is that there are very great differences between the way the event is interpreted around the world. And that one of the reasons why the Europeans are so disappointed is they had very high expectations that the agreement would look a lot like the kinds of international agreements which, on the whole, the European Union favours. Top-down, directional, allocating responsibilities, enforceable in law both at the international and domestic level, with an organised international procedure for reviewing and calculating how much progress is being made. And what has happened in the group that was formed in extremis by President Obama, initially around China, but then including what are now called the basic countries, without Europe initially, although they came in the end with the 30 countries that agreed the accord, is an agreement is much more bottom-up, where you pledge and review, you pledge commitments, and then you review them later, where the burden for creating, for example, the demand for emission reductions in a future carbon market is placed largely on domestic regulation and less on global, although they will need, all those countries will need international standards in order to make that system work properly. And the two models are now in direct opposition, and it's going to be very interesting to see how Europe copes with the fact that the small group that led to the Copenhagen Accord being formed is a group of a very interesting new power structure in the world.
Can you comment on coming to the financing piece? Because the accord included these quick start funds and an aspiration towards 100 billion. So of my 500 billion figure, there's 100 billion that's now written in, well, law, not law. Does it exist? Do the quick start funds exist? When are they going to be spent? What do we actually get there?
There's a lot of questions there.
Yep.
I mean, whether it becomes law, we don't know yet, but the intention at the moment is that it does. Right? But there's a political commitment to financing, and it was one of the positive outcomes of Copenhagen. So I regard the breaking up of the division between the harsh, unrealistic division between developed and developing countries that happened in the Accord as a positive thing, and we might want to come back to that in due course, but I regard the financing commitments, which are significant in multilateral negotiation terms. They're nowhere near the number that's required, as you correctly state, but they're not bad as a start. The 30 billion that is pledged for a prompt start is public money that will go largely government to government and is associated with capacity building, preparing for more money coming, enabling governments to be better organised to receive capital, including private capital. The 100 billion is meant to be a blend of public and private, although no clarity whatsoever about how that blend is going to be achieved. Which institutions, are there going to be new institutions? Is it going to be Jack and others providing the money through specialist managers? You know, that's not clear at all. And there's a lot hoped for in that 100 billion out of the carbon market, when the carbon market is actually struggling to get any kind of certainty over the future, even though it's made a promising, faltering start.
So in summary on the financing piece, we got the quick start funds is real, but it's 10 billion a year, and it's going to go government to government and have to do a lot of different things. And the 100 billion is out there, and that's perhaps something that which is certainly something that we'll come back to and try and figure out where it might come from. I want to move on and bring in Ken Hersh. What is the scale of what is the scale and the nature of the transformation as you see it that is required? So moving away from Copenhagen to the people who build stuff that produces energy. What does this actually look like, and where is the money? What are the financing mechanisms being used?
of course, we could talk for 24 hours on that one topic. For context, I run a $9.5 billion energy capital management business that spans the spectrum, conventional as well as technology and energy infrastructure. I've been doing so since 1988. So we've seen this movie before. We've seen it. We've seen it in Rio. We've seen it in Kyoto, and we've seen it in Copenhagen. I think that the goals, as I would phrase them, coming out before Copenhagen, the big push pre-Copenhagen, and then I think what happened at Copenhagen was very obvious, is that the goals are aspirational, not perspirational. Okay, they're what people hope for, not what we can get to work on. The energy business is not going to go away, and it's not going to transform, unfortunately, to a low-carbon system. It could be lower carbon, and that's a good goal. But a low-carbon energy system in the next 30 years is totally unrealistic unless we want to turn back the developmental clock. Right now, people have to appreciate the scale of the energy business. It's an $8 trillion global business. The governments cannot support the entire chain of building it, operating it, and then incentivizing consumers and subsidizing consumers to use it. And that's where I think the challenge is that everybody's quick to commit other people's money. And that's where the weight of the system, when you actually come to the implementation, breaks down. In the future, what the world is going to look like, and I think the world will mobilize capital and policy to a certain extent, but it's going to be one step forward, a half a step back, and it's just going to ebb and flow as national priorities and energy security and economic growth come to the forefront, and those don't often square with low carbon energy, which is more expensive, less reliable, not necessarily domestic, et cetera. So those are the trade-offs. There's a reason why hydrocarbons are the dominant source. It's because they're efficient and they're cheap, and it took 100 years to get where we are now. We're not going to unwind it in the next 5 or 10 years. So most serious estimates of the future, the next 30 years, look like conventional hydrocarbons market share may go in the 80% range, 70% range. It's not going to zero. So the future is going to need all of the above. Because economic growth is so overwhelmingly important to the world and to the emerging economies that they're not going to take a back seat when it comes to their energy growth to serve just the master of low carbon. They have to serve other masters. So I'm an all of the above guy. We're going to need oil. We're going to need primarily natural gas, which has an enormous revolution in the United States that's going to be exported to the world in the next 10 years. And that should not go unnoticed, because last year and 2 years ago, natural gas was dismissed as being limited. Okay, the United States today, 100-year supply of natural gas due to new technologies to develop the unconventional resources. And those resources exist. So we'll have oil, we'll have natural gas, we'll have more nuclear, and we'll have alternatives. How that gets financed, okay, I think it has to get financed through primarily private sources, because the market's just too big. Governments around the world will go broke if they have to subsidize the creation of the energy, the operations of the energy, and subsidize consumers' use of it. So that's where the debate needs to move towards, as to how the private sector is going to be, is going to not necessarily be incentivized, because you don't need to incentivize the private sector. If it's economic, they'll do it. It's how to get the technologies to the economic phase, and don't waste time and money on things that aren't economic.
But that will require some interventions. If you want energy diversity, as you've described it, that's not going to happen by itself, is it?
Well, right, and I think the mistake that is happening right now is that people are viewing the energy future as an either-or. We have the conventional guys, and we have the alternatives and renewables, and we got to get rid of the first, and we got to promote the second. People don't recognize that the energy companies are incredible innovators, and they have the mindset to reinvest capital. They want to pad a little bit of dividend, but they want to grow their businesses, and they're energy companies. 44% of the alternative and renewable spending from 2000 to 2008 in the United States was done by U.S. oil and gas companies. The administration today is making enemies of the incumbents. You're crazy. That's where the capital is, and that's where the expertise is. Why would you unwind nearly half of the investments? So that, to me, is what needs to be brought together. is rather than making enemies out of the incumbents, is actually to use the incumbents because they sorely want to reinvest in their businesses.
Okay, let's turn to Tanti. This is very interesting because that's certainly the case where there's a fully developed set of incumbents. But that's not the case all the way around the world. There are also countries where there are people with no electricity provision at all. I think the figure is still around 1.5, 1.6 billion. Now, I just want to say, before I bring Tanti into this, you obviously selling a lot of turbines in the US and around the world. But if you could take what Ken has said and say, how is it different in other countries that perhaps are not at the same level of development of their infrastructure?
I think we are in a very complex situations because one part of the world is a developed world and other is emerging economy or developing countries. It's a huge different challenge. Is there absolutely right? 1.5 billion population of the world, they don't have access of the electricity. If you take a general numbers of that, one part of the world is consuming the electricity is 700 kWh per capita, where other part is required 14,000 kWh per capita. So it's a huge unbalanced scenario is there. I think we have to develop our world more efficient way. One part world has to focus on more energy efficiency area, and other part of emerging economy has to focus more to develop efficiently, because they have a great opportunity, new technology and new resources are available to utilize that to same time to bring down the low cost of the energy also, and to develop the energy securities and provide the energy to the poor countries. So I think that is the biggest opportunity we can say, and there is a tremendous resources are available. Technology has developed on that. If we can bring on that focus, I think that's a developing economy can bring that. I think recently, if we say the last year in 2009, the 12,000 megawatt it's installed by the China, and 2,000 megawatt is installed by the India. So there is a nearly 30% of the new energy source is coming from renewables. So it is a more efficient development is going on. And when we are talking about the resources of the renewable, I completely agree we have to use all the resources. But same time, we should not forget how to mitigate the climate crisis. And that is the challenging part is there. Now, coming to the developing economy, the biggest challenge is the resources of the finance and money, where to come. How we can connect the governments, and also how we can connect the local populations who can start an investment in going on. I think policy framework in the developing economy can bring the different view. I can tell you the very small and success story of the India. Most of the part of the world, the large utility is doing investment in renewables. But India is directly industries and directly consumers are doing investment in the renewable energy, because that policy is providing willing and banking mechanism. So you produce your energy and you mitigate your requirement and you can hedge your power cost. The same time, you bring the energy security and sustainable development of the business. So I think that is the good mode of this. So the policy and the finance resources of the government and the global framework, I think that can bring the sustainable development of the whole world.
Let me just push on something that you said, that the consumers in India, and I think you were meaning industrial consumers, but it's also happening with retail consumers who are, if they're not grid connected, it's actually economically makes better sense to use a solar lantern than to buy kerosene. So is that, are you seeing...
Yeah, it's a 300 million population in India. They don't have access of the electricity. There is no sense to go with the conventional way of the development of the energy and to build the infrastructure and grid. It should be a standalone, village-based resources. It's not just a house-based, but the local resources, we can develop that. The bioenergy, the solar and wind, the combinations, and we can provide that. And they are not... the important for them is, okay, I need the energy during these times. They need the certain requirement, basic. So if we can satisfy that way, align with the resources available, I think that is the good sustainable development is possible, and to give the better life for them also.
So that's a very positive story, that there is actually clean, renewable energy that makes pure economic sense in those situations, but it's not broadly spread across the whole of the economy, and some policy is needed, and also some capital formation that's simply not there in the developing world. So, Simon, we've got this picture of everything from commercial technologies, not just in the developing world, but also in the developed world, there are situations where the clean technologies make pure economic sense, but broadly speaking, we're going to need a lot of interventions, and also a lot of them will be around the financing of this. How does one make sense of this? As Ken says, the money is going to come from the private sector, but it's not going to flow until the frameworks are in place.
Yeah, I was thinking as I was listening to the other speakers about the session that we had in Dalian a few months ago at the World Economic Forum, where we kind of begun a similar discussion, and it was similarly focused on low carbon growth, although it was called green something. And kind of halfway through the conversation, a number of folks said, you can't look at this lens purely through a low carbon parameter. You have to look at the broader matrix of sustainable development. And I heard the words just a couple of minutes ago. And I don't think this is just a sort of polemical issue when it comes to thinking about the role of the public sector. Are we conceiving of a low carbon underdevelopment? Yeah, and do we think that's possible? Or do we need to understand the role of the public sector, particularly where there are countries with considerable inequality and poverty, access to water problems, livelihood issues, in a broader context? And it seems to me more likely that we're going to be able to engage the public sector in many different forms if we look beyond the strictly low-carbon, climate efficiency, energy-efficient lens at some of these broader parameters. So that would be a kind of a first piece. Second piece, I just want to come back to the numbers. Not because any of us really know what the numbers are, but just to kind of put them in context. In the run into Copenhagen, there were a lot of folks that talked about incremental costs, i.e. the stuff that isn't going to be paid for by the private sector, at something of the order running up to about $100 billion a year or 100 billion euros a year, depending on who you talk to, by 2020. And the number 100 billion, of course, popped out from Hillary Clinton, although it didn't pop out as what's needed from the public sector. But as you said, James, she converted it into a sort of blended, slightly obscure model by that time. $100 billion is not that much. And I know we're all in pain over public sector funding at the moment, but I do feel we need to put this on the table. $100 billion costs, in sovereign debt terms, these folks will know better, $4 to $8 billion a year. Peanuts. We spend $40 billion a year on pet food around the world, and we're talking about saving the planet, or at least the folks that live in it. So we have to look at the role of the public sector, the financing gap from the private sector, within the right framework. Otherwise, one feels one has an impossible task with an impossible set of numbers. Thirdly, it seems to me that the danger coming out of Copenhagen is that the lesson that we take from it is that we need to innovate differently at the global level. And I feel that's profoundly mistaken. It seems to me that the lesson coming out of Copenhagen, as well as other failed global venues, is that we need to innovate around public-private collaboration at the national level, or even at the sub-national level in many respects. And I just want to give two brief examples. One, and they're both not solving the bigger problem, but illustrative possibly of pathways one can take. The first is existing, and the second is prospective. The Amazon Fund, that many of you may have heard of, or some of you may have been involved in, established in Brazil, a collaboration between many different players, including the Brazilian government, civil society organizations, private actors, international organizations, the Norwegian government, seeking to find ways, irrespective of what happens to the carbon markets, of leveraging international and national money into approaching deforestation and better managed land use in Brazil, particularly in the Amazon area. It seems to me a very interesting example, still at the beginning of its life, of how to build collaborations at the national level that both is a means of mobilizing international cooperation, particularly international public finance, independently of whether or not there's a global deal, and blending it together with both domestic public money and domestic private money to do a range of different things at the operational investment level that works, I think that could work very interestingly. And I think that Amazon Fund model kind of opens the doors to thinking about different ways in which to build effectively varied kinds of trust funds or investment funds involving both public and private actors at the national level, whether they be for a broad-based topic like adaptation, or whether they be quite specific in one or other sector or technical area. Second example is South Africa. Folks on the panel will know better than me. South Africa has significant potential in the renewables area, particularly in solar, and yet there is absolutely no investment at this stage in that space. And the question is why? And of course, part of the answer is pricing of coal in South Africa and the lack of pricing of carbon prices. This is the old story. What does one do? So the South African government has created a renewable feed-in tariff. The renewable feed-in tariff looks great on paper and is completely dysfunctional and non-operational in practice. Why? Because they can't afford to pay the renewable feed-in tariff, so that in practice they don't mandate any independent power providers to make any investment in renewables, investments that would be made if the refit model was enacted in practice. Exam question, what does one do about it? Yeah, the potential is there. Yeah, in fact, the legal mechanism is there. The investment is not being made. There's extreme institutional dysfunction, as many of you will know, within Eskom and the rest of the kind of energy scene in South Africa. Discuss, design, and solve. In fact, I think that's the topic of Davos today, as I remember. It seems to me, actually, these sorts of problems, although perhaps in the examples specific to South Africa, are very common in many different countries. In this particular instance, there is an initiative in play that I and others are involved in that lifts some of the learning, in fact, from the Amazon Fund, completely different continent, completely different subject, and begins, I think, creatively to think about how one can leverage international cooperation from countries that are not responding to a global climate deal and associated commitments, but are responding out of national interest, out of the potential of longer-term joint venture, industrial development, building value chains around renewables in South Africa, and can channel funds not necessarily into traditional modes of carbon abatement, but can channel funds actually through a subsidization of the new renewable feed-in tariff to leverage investments in renewables in South Africa. The takeout, of which are two, is let's not try to substitute a global deal which is, as James said, sort of top-down compliance built with a set of global public-private partnership architectures. I think this would be a catastrophe. It will lead to gaming, corruption, bureaucracy, delays, and frankly, very little else. Let's focus on PPPs at the ground level, where folks actually understand the nature of the institutional catch-22s that are preventing action. Fast fund, let me just come back to that finally. Yeah, it is very possible that the money will be wasted. Why? Because nobody can think of what to do with it. And so it's very likely that large parts of it will flow through bureaucracies that are fundamentally part of the problem, that will invest in bureaucracies that will remain part of the problem, and that will build capacity that is unable to really help us in practice. This would be a shame. Yeah, I think there is an alternative, which is that part or all of the fast fund is used to seed initiatives like the Amazon Fund, like the work that's going on in South Africa, to effectively fund innovations on the ground that bring together public and private players to try things out and get things going. At the moment, that is absolutely not how it is being discussed, but I think there are opportunities still to push that approach forward.
Simon, thank you for that. And I want to ask a clarification question. It's sort of similar to the one I think we crossed swords a little bit in Dalian on this question. The Amazon Fund, you know, it's nice to use words like public-private partnership and so on. Where does the money come from to pay back the private investors in the Amazon Fund? This is just donation money, is it not? This is just aid money called a fund because that's what we do these days. We try to form public-private partnerships, but essentially there's not going to be any return on the investment in that fund, is there?
Yeah, I think the interesting thing about the Amazon Fund at this point, you're absolutely right, and I wouldn't say we crossed swords, but we had an interesting discussion.
We have the same discussion now.
Indeed. Well, I'll keep it brief since we've done it before. So I think the interesting thing about the Amazon Fund, obviously it doesn't solve all problems and all issues, it is that it creates a vehicle for international public finance to be blended with national finance and potentially some private finance, not at the international level, but at the project level. Yeah, and so without going into the details of the architecture, it allows, particularly through the Brazilian National Development Bank, for sub-ventures involving public and private players to make investments that in and of themselves can deliver a return to private capital, with international public finance not looking for that return, flowing in from the top, paying for carbon abatement or mitigation that can seed those projects.
And I like the example. I like the fund and I like the example, but it is at the extreme end, in a sense, of public-private, where all of the revenues, either the money going into the fund or the things that create the revenue to pay back the investment if it's private money, essentially come out of public purses at various levels. And I don't think that's a bad thing, because some of the problems, some of the issues require simply public interventions. Adaptation is going to require public funding, whether it's public capital or public revenues to reward private money. That's really the only way to do it, isn't it, James? Or am I missing something?
Well, it is. I mean, one of the things that we need to be clear about, not least in the international negotiations, is the difference between money spent mitigating and money spent adapting. And adaptation forms a part of a solidarity payment because it's right and just and sensible to provide the resources for those who don't have it to cope with the consequences of climate change. But the bulk of the money that's required today is in mitigation, and very small amounts of public money are required actually to produce big reductions in greenhouse gas emissions. The bulk of the money is going to come from the private sector, and it's perfectly appropriate. There's nothing worrisome about that. It's a question of whether or not you can use public policy to incentivize a capital flow that is larger and more directed, better directed and quicker, even allowing for the fact that we are going to continue to invest in high carbon infrastructure and fuels for a very long period of time. So it seems to me that the tension at the moment is by trying to place the entire burden of financing climate change into this unwieldy international framework, trying to do everything all at once. There's a pressure to do that, I quite understand, but breaking the problem up, cleaving the mitigation and adaptation costs and seeing that there are different sorts of funding first, and then recognizing that making things happen on the ground requires high levels of cooperation in a place where risks are understood and returns can be made to private sector investors. Otherwise, of course, the money won't flow there.
And you're right about, the looking to Copenhagen or that process as the solution is absolutely not great. I want to come on in a second. We'll move on and we'll talk about the other parts of the problem, because at the end of the day, let me come back to some figures. The 100 billion, I started by saying that 500 billion is needed. That is global investment in clean energy, energy efficiency, carbon capture, right through the value chain globally. That's a total investment figure. I think the 100 billion that gets a lot of focus is the amount that the developing world needs that it doesn't have itself. So that's the piece that gets a lot of focus, and indeed we're talking about it here, and we will, in due course, move on and talk about the other 400 billion that is needed. But I just want to, since we're on that topic, I want to move to Jack. There's a lot of focus on leverage. So we'll do various things, whether it's an Amazon fund type structure or whether it's through policy interventions or carbon markets. Talking about that 100 billion, the focus is how do we get small amounts of public money, because that's all we've got because we spent it all, and how do we leverage that and get private money? And you are essentially, you are who they're talking about. What will get you to put substantial resources, not a few hundred million, but in the billions, into that pot of 100 billion per year that's needed?
Well, let me take a minute just again, refresh for everyone just our position. So I run CalSTRS pension fund out of California, and we service 800,000 teachers in California, and we're about $135 billion fund this morning. But I'm not proud of the fact that we used to be a $180 billion fund not just so long ago. So in terms of positioning and the capital that we have, and in our situation, it's not that different from other institutional investors of our size in terms of that proportional loss. But there's no doubt we have an awakening of how we view risk and how we view the portfolio construction and where we see opportunity going forward. So the topic we have today is, in fact, a perfect intersection for where large institutional investors are thinking. There are three areas where we can make a contribution as institutional investors to catalyze those dollars you're thinking about and referring to, Michael. The obvious one, which James has already touched on, is around policy advocacy. And I do want to point you to, I think, what is a very clear-headed document that we issued just this month at the United Nations event, and another document just a couple months earlier from our investor coalition. And that's composed of investors from the United States, from Europe, UK, Australia, New Zealand, and it's about $13 trillion worth of investors involved in this. So to see a clear policy statement coming from institutional investors on what is needed to catalyze dollars like this is an important message right now where we stand. When you hear the chaos among government leaders and the inconsistent approaches that are being talked about throughout the world, I think you are seeing a greater convergence among institutional investors on what are those key ingredients that need to take place right now to start to mobilize capital. And again, just to put another metric on the issue, so we're a $135 billion fund this morning, but in terms of our total investments, and we've been working in this space since about 2004, but in terms of our private equity investments, our public equity investments, those range just around, a little around 1% of the entire fund. So you can see the capacity of investment that is really still greatly available to all of us as we see these other pieces fall in place. Most importantly, though, is that policy framework. And if it isn't a global treaty, it's clearly putting pressure on nation-state strategies right now going forward, and also on regulatory disclosures that will also bring clarity to investors and move that capital forward through public-private partnerships. We're hoping for a very positive announcement here in just a few hours from Washington, where the SEC, after much effort from institutional investors, has been pushed and pushed and pushed to offer interpretive guidance that will clarify what public companies in America need to be disclosed around climate risk. If that happens in a few hours, then in fact that train is starting to move a few more miles down the track, and investors certainly are going to take note of that very carefully. Same on the risk management side. Two statistics which I hate to say, but are shocking to me is, again, the INCR, the Investor Network for Climate Risk in the U.S., just issued a survey of its asset managers. And it was a large survey representing $8 trillion worth of asset managers. And the two numbers that stand out for us is that 44% of our asset managers do not consider climate risk at all in their investment analysis because they don't think it's material to their investment decisions. And then the one that is an arrow right through my heart is 49% don't analyze climate risk because their clients don't ask them to. So with that revelation, we quickly changed our performance discussions at CalSTRS, and regularly now with all of our managers, this will be part and parcel of that discussion, is what you are doing with our money in our portfolios, analyzing climate risk. So again, I think you can see institutional investors starting to take some very clear steps. On the opportunity side, we are in fact an LP in a number of thoughtful progressive funds. And in these dire times, I guess I'm glad to say to you that as we do comparative investment performance, those funds that have a sustainable orientation are doing reasonably better than many of our other funds. So I think we've got some reasonable early validation, even though we've been in this sooner than other players, that we're heading down the right track in what we do. This last piece around really now finding what does it take, what are the final obstacles to bring in more money, in part will be generating that public capital that can, in fact, for every $1 of public capital, you could have $3 to $15 of private capital alongside that. And I think that's exactly where we see our next play.
I want to come back to you in a second on some of those investments that you have made, but just the question about the $100 billion to go into the developing world. Of that 1%, how much has gone? How much is in?
Oh, there's no doubt for not just ourselves, but our colleagues that there is a strong geographic bias in the 1% that we put in, and is absolutely in the developed
We'll come back
countries.
and talk about where
Absolutely.
it is, but just so that is definitely one of the financing gaps, and what would I'm going to come back. I'm actually going to ask my question again. So what would make you look at those opportunities in the developing world? What sorts of things? Give me one or two examples of concrete things that would make your decision different. That you would say, you know what, I can put money into clean energy in Egypt or in Malaysia or in Mexico or some of the countries, South Africa. We have the Simon's example.
Right.
What would you need?
Well, and it isn't. I'm not sure the question's that much different for the broader portfolio, right. And why don't we spend a greater percentage in those countries as it is? There's no doubt institutional investors are a plodding, methodical lot, I think, with a lot of pragmatic perspectives on issues. And as to being first out of the chute, in those high-risk areas, that's something you're not going to find with a long-term patient investor. So the direct answer to your question is there's going to have to be some specific mechanisms dealing with risk mitigation on those investments. Absolutely.
And you see that as being, I mean, is it can you be more specific? Sovereign risk type issues, energy policy risk type, or is it just all?
I think all.
Okay. Simon, you wanted to come in.
Actually, I wanted to ask a question because to yourself, if that's okay, which was when you gave your list of New Zealand, Australia, the UK, the US. I can't remember if there's anywhere else. It's all sounded like they all look pretty similar, and I was curious, and I was just curious about Asian wealth funds, Middle East, Singapore. Just talk us through a little bit where the institutional investors are there, rather than the sort of same Anglo bunch.
Well, part of this comes from an activism stance as institutional investors in terms of advocating for policy change or lobbying the SEC or government leaders. And I think those institutional investors from the countries you mentioned that have stepped forward are those investment cultures lend themselves to that activity. The others that you mentioned are quickly quieter investors. I think they probably will see opportunity in this area, but they certainly wouldn't be at the front with us signing advocacy statements as much. I'd like to see that change, but that's part of that corporate governance activism that you see in certain institutional investors, and you don't see it in others. There is definitely a quietness there. It doesn't make them less effective.
Sorry.
I think that Jack segmented the role advocacy versus investment is right. We have 400 limited partners from around the world. They care about one thing: returns. That's what they care about. The niceties of climate, when all the surveys about what do you think about climate, it's a nicety. It's an important. It's one of a dozen very important things that's on their mind. And until you can find a way to make competitive, above-average rates of return, the capital isn't going to flood there just for the nicety effect. So to me, it's really, really simple. And so there's two questions. One is the formation of capital in low-carbon energy efficiency, alternative energy, et cetera. Those can work in selected areas, but if I went out to raise a fund and I said to Jack, I'd like you to invest in my fund, and the sole reason my fund is going to exist is because of a coordinated global policy that's not going to change. You'd look at me like I was from Mars. It is not an investment proposition in the private sector to invest based upon sustainable global cooperation over long periods of time from a policy perspective. It doesn't work. So that's the important thing. The second thing is if you're talking about carbon and you're talking about the energy equation with carbon, you have to focus on things that are scalable and directed at the problem. Simon, those examples are great. They're ground floor, they're innovative, but they're small. We can talk about the developing world. The developing world can pollute all at once, and it won't matter to the overall CO2 emissions of the planet. If you want to solve the carbon emissions of the planet, you have to take market share from U.S. and Chinese coal. That's about it. If you don't do that, everything else is irrelevant. So I think that you need to separate these issues into, do you want to attack the problem, and do you want meaningful solutions? And if you want private capital to go in, think about how to get things across the hurdle. Okay, and I used the example before, because this is really important. There's 3 ways the government's involved right now. They're involved in subsidizing the building of renewable energy systems. They're subsidizing the ongoing operations of them, and they're subsidizing the consumer to use them. A perfect example, okay, and it's all been sort of debunked, but it's still out there, is corn ethanol. We pay the farmers to plant corn, so we pay the refiners, the blenders, a credit to blend, and then we pay the consumers, in effect, by putting a tariff on Brazil, okay? So all 3 of those things, the government involved in all 3 of those things. As a result, it's a completely unnatural market, and it's not sustainable, and it just sucks capital with no real result, and it gets gamed. There is a way. So think of the 3 things. If the public sector gets involved in getting big capital-intensive energy systems in place, but then once they're in place, they're cheap to operate, and the consumers are happy to use them because it's competitive. So the utilities can own them and operate them, and it fits right into the grids, and the consumers can buy them, and it's competitive. It's competitive with all the other sources, such as nuclear power, okay? A lot of other issues with nuclear, but nuclear has big, huge capital costs, but once they're in, it's relatively cheap to operate, and it's very cheap to use. So it fits right in. That's where the government could make a huge impact with significant dollars, but a manageable number of dollars, and really impact the carbon equation, because nuclear power can take market share from coal, because coal is an electricity provider. We don't power our cars with coal. So you got to go after electricity, and you go after market share. So it's coal, it's nuclear, and natural gas.
Let me bring Tanti in here, because you've taken it. I think it's very useful to focus on coal, but of course there are other technologies than nuclear that take market share from coal, aren't there?
So I agree with you to some extent, but the investor point of view, it's extremely important. What is my return of investment? That's very clear is there. I see it is a great opportunity is there today, because one side we need more and more energy, and we have to change the portfolio of the energy. Both we have to do. So that we have to mitigate the risk also, and same time to generate the opportunity. I think it's a great time is there to invest in that. Enormous opportunity for the investment in the technology investment, same time infrastructure, because we have to redesign our infrastructure on the developed world, and same time in the developing country we have to build the efficient infrastructure. We cannot follow the other way. So there is a great energy benefit is there, and investment opportunity is coming out. So it will bring the lot of investment. And if I see an analysis of that, okay, where we can invest, whether we can invest in the high return area or whether we invest in the more security areas. So both is becoming very important. I think sustainable development will bring, that is the challenge is there, and that will bring the biggest opportunity for the investment. Because when we are going in a developing country, because need of energy is so large is there, we have to use hydro heavily. We have to use the nuclear also very strong. That will provide the base load. And same time, we should bring all the renewable resources. It is additional resources. We can bring the need of the requirement, same time to mitigate the climate. I think the return on investment in the renewables area, it's becoming extremely lucrative, because day by the technology is becoming so competitive, and it's bringing the lot of efficiency on that. And that is a long-term return investment
Right.
is there.
And,
So-
and I would say the key, and there are wonderful developments in alternative energy. And wind, the growth in wind has been phenomenal. What your company has done has been absolutely phenomenal. Starting from a very small base, and the work that the people did on pre-Copenhagen about the developed world needs to peak their emissions now to make room for the developing world. The developed world doesn't have time to go to 20% renewables in the next 5 years.
We could spin off and talk about nuclear versus, although in fact it's interesting because you started by saying you're a believer in all, but then you actually what you're really a believer in, at least from the last intervention, is replacing a coal monoculture with a nuclear monoculture.
No, that's just electricity. Electricity is only a portion of the whole energy
Let me
mix.
just say that there are some canards about how quickly one can roll out clean energy, and the addition of capacity and the addition of not just capacity but production in renewable energy has far outstripped nuclear for the past few years. And if you talk to Spain, Denmark, Germany, and even parts of the US, we're getting to meaningful proportions of the energy mix coming from clean energy, not without its problems of intermittency and so on. But I want to come back. Jack, you've got one thing.
We just finished a kind of a quiet study of the largest pension plans around the world, and kind of looking for those of us that had worked in this area and had made investments over the last 5 or 6 years. And by far, probably 80 to 90% of all the investments that have been made, primarily on the private equity side, were on the carbon intensity, the solar, the wind, solar thermal, and some on carbon demand, energy efficiency, and then very little on carbon sink. And I just want to ask James and Ken, just what has been the problem on energy efficiency? If that is one of the best leverage points we can have here, why have there been that lack of investment vehicles here for us to move forward on, do you think? Why is that lag so much? When I look at the distribution of dollars for the big institutional investors, it's so biased toward that one side. Not that it's bad, but why don't we have a better diversified portfolio of funds going forward? When you read any of the McKinsey studies or any of the things, it would point us to a different direction. What do we miss in there?
Well, certainly, if you look at the McKinsey curve, you kind of expect it all to be done anyway, and then have to ask yourself, well, why hasn't it been done? And the answer, in short, is that there are either cultural barriers to energy efficiency, there are operational barriers, there are often legal barriers, the responsibility for getting the job done isn't with the owner. But I would, can I get to the conclusion for your question a slightly roundabout way? It's clearly true that an institutional investor like yourself or others are not going to make investments in specialized funds to deal with climate change like ours unless you see financial returns. But it's equally clear that we aren't going to solve a major collective action problem unless we can combine public policy and private finance. So there is nothing wrong in making a very strenuous effort to align incentives between private capital and delivering the public good. Now, I happen to have founded an organization in a rather entrepreneurial way to try and make a small contribution to solving the problem. That's why Climate Change Capital has an idealistic orientation, creating wealth worth having. But we aren't going to do the creating wealth bit unless we produce financial returns. And we're not going to do that unless the interventions that we've been talking about are successful. Now, there is a suggestion that you frequently get in gatherings like this that there really isn't enough to invest in that fits in that box between delivering, which contains delivering public good and private returns. And our experience over, let's face it, only nearly 7 years, is absolutely the contrary. If you go looking, including for energy efficiency, you find. And we have no problem with deal flow in any of our funds, whether it's private equity, property, infrastructure, carbon. There is just a massive amount to invest in. We also know the money's there to do it. At the moment, it's quite difficult to make all of those connections. But there is not a problem finding things to invest in at scale that deliver the public good of reducing emissions and very good risk-adjusted returns, including in energy efficiency. However, what it seems to take is almost like a trick to open up. You need to find a way in. So we have hundreds of millions of tons of projects to do through the clean development, the rickety old clean development mechanism, many of which are pure energy efficiency. They should be done anyway in China and Southeast Asia, but they're not. But funnily enough, if you go along saying we'll pay for it with a carbon price that is not public money but a public policy structure, it gets done. Now, eventually, doing more of them, telling the story, having a narrative, will make it more obvious for someone to do it without relying upon the international capital to do it. But my sense is that we have plenty of examples to do today with what we've got, i.e. with policy frameworks we already have. We just haven't done it yet. We haven't told enough stories of the success.
And you use the word trick. I got a better trick, okay? When oil and gas prices went up, the market is an incredible thing. And all of a sudden, efficiency made a lot of money. Okay, our energy technology fund has been investing primarily in energy efficiency plays, but we didn't have obscene commodity prices until about 3 years ago. But the market, it doesn't need a trick. When oil prices at $150, all of a sudden it became a very meaningful portion of everybody's cost structure. And if they could find ways to reduce it,
People still didn't do it.
it became, well, it got in the mix. The lead times to get it done, all the deal flow we're seeing now is, I think, a direct result of the marketplace focusing on and being receptive to the fact that we might need energy efficiency because we may not have low commodity prices.
May I give one counter, very brief?
Very brief.
In our property fund, we've made purchases of commercial buildings. Principal object is to make them more efficient. Right? So you could do all of this anyway. But many of the barriers are purely that either I don't know how to do it, or hasn't been done before, or I don't have to do it because I'm the occupier. When you set out to deliver the task, because you're motivated, you want to do it, you change the commercial relationships. You provide a story for someone that someone else can follow. Those barriers are largely soft, cultural. They're not to do with simply the commodity prices.
Yeah. There are also issues around energy efficiency in terms of how do you structure that investment so that a third-party investor can take advantage of it. And I think there is very good work being done on that, as I believe, in the US, in Europe, certainly, and around the world. But that's one of the challenges, is it not?
Yes.
Yeah. Look, I want to move on, and because I think what we're doing here is we're starting to talk about some of the other gaps in financing. We talked about the developing world, energy efficiency, partly a gap in financing, partly a soft gap, maybe an agency gap, and so on. But there is a need, if we're going to solve this problem, for much more funding throughout the development cycle of new technologies. And Jack, you said something in your opening remarks, which I wanted to come back to, which was that you looked at the returns from, and I want to point out that Jack kicked off a very important initiative, which was the Green Wave initiative back in 2004. He's being very modest about that. But that really got attention of a lot of fund managers because it was the first time that an institutional investor had said, here's a pot of money, come and talk to us. And I'd like to hear a little bit about that process, because it was so important. And now it sounds like you've got some of the results of that in terms of some of the returns.
Right.
And a lot of that was technology development type funding, was it not?
Right. Well, I think without boring those of you that aren't lawyers in the audience and want to hear all this, but I mean, obviously for those of us that our pension systems were guided by strong fiduciary legal guidance that is fairly conservative historically in the United States. So frankly, back in 2003 and 4, not only was there the purity of the investment decision we needed to consider and whether or not this offered the opportunity we wanted to see in the fund, but also did it fit within the legal guidance that we would have as fiduciaries. And that's one of the most significant changes, I think, not only at CalSTRS or our sister fund or others that we've seen, is a redefinition and a broadening of that interpretation. And that certainly hasn't been the case on the European side, but absolutely in the US, it's been a far more conservative lot in defining what that means in terms of your investment strategy. We have literally gone back at the time. Not only did we see opportunity here, but we literally gone back and you change those investment policies and incorporate environmental, social governance factors as not just extra factors in making your decisions, but part of that core set of principles to conduct that analysis. And that's been much the driver for the core staff because, again, we've a bunch of pretty traditional people looking at this stuff, and you have to have a real change in mindset. So that, accompanying with the broader decision on the asset allocation, I think is what started to propel us through this change going forward. And unfortunately, in private equity, it takes time to either validate or challenge the nature of the decision you've done. But also on the equity side, we've been involved in some sustainable funds that have been very promising, even though they have very long-term prospects. And it also makes you, I hate to say this for those that are running funds in the rooms, it makes us think harder about whether we've done our job and on our fee structures with our managers, and whether we've set the right incentives in place. It isn't just, if we're really walking the talk here, we're talking about sustainability and long-term visioning and all that kind of good stuff. How come, in fact, we have a compensation model that directly conflicts with that orientation? So, in fact, it's been, I think, good for us, again, as I talk kind of openly with you, and I think our own change in philosophy and understanding, we recognize ourselves that we've been bidirectional a little bit in seeing that investment opportunity, but not necessarily incenting the managers correctly, and as I said before, even challenging our core managers. So I think that's that next change that we'll see.
But if I was a pension fund that has not gone through that exercise, maybe European, maybe for whatever reason has not done that sort of gone through that process, or a sovereign wealth fund who's quietly investing and just looking, much more focused perhaps on returns, what could you tell me in terms of, have you had to trade off performance in order to do that? What is the experience starting to say?
Well, we've traded a lot of performance off of this last year, but not about this. That's clear. Again, I just want to go back to my opening comments.
But relative to other parts of the venture and private equity type investing,
right?
So,
right. No,
like for like.
No, absolutely. I mean, I think in fact we've become much smarter about risk management and recognizing the role this actually plays, the positive role this plays in the construction of the portfolio. So, in fact, we have made some mistakes. There's no doubt about it. These last couple of years and how we've strategized parts of the portfolio, but I think we absolutely have no regrets here. But the question again going forward is, how do we accelerate that in good vehicles that make sense for the fund?
Okay, but the situation a few years ago then of this sector as being something you have to want to be green and not go after the return. That era is passing. Has it? Well, where there has to be a trade-off, where investors say, well, if I just want returns, I can't look at this stuff.
Right. Well, being in California, obviously we have mucho social movements around many things, and those often come to play in the pension fund where we're pressed to take on investment strategies
Tanti,
and benefit those issues. And I think this is one, though, where we've really done that reconciliation now, where this is not about that orientation, even though I have a membership, be honest, frankly, the people that are getting the pensions out of the system here ultimately do judge you whether you're investing the money well for them. And I make speeches throughout California all the time, and inevitably this comes up in every audience I'm before in terms of, are we actually doing the right thing with the pension fund and making money together? So I think the reconciliation's there. I do.
I want to touch on one other area that has been described in many places, a financing gap, in fact, a valley of death, before opening it up to the audience for questions to the panel. Ken, you've got various funds. How many of the technologies, some of what Jack has been investing in is earlier stage technologies through his through the funds he's chosen, and then those technologies come out and they try and persuade you to fund projects using them. How's that been going?
Well, as I said, we've done a lot in the energy efficiency. One is Lehigh Technologies. It's featured here at Davos as a technology pioneer in the energy efficiency area. For us, unfortunately, as Jack alluded to, I would put core principles of sustainability as one of the core principles that we would have with ethics and honesty and integrity. If our returns suffer, then we're all going to be out of a job, and the pensioners are not going to have their health care. I mean, that's the way it works, and the universities aren't going to have their endowments. So we have to look at basic market-driven economics when we look at transactions. That doesn't mean that there aren't lots of public vehicles and public tools that everybody uses, primarily the utilities. The utilities are wonderful purchasers, that you can count on, and there's financing behind that. So I think that I look at this and say, when it gets to my stage, it's got to work in the marketplace. There can be certain government policies that perpetuate it, but those have to be tried and true. If otherwise, we're really just kidding ourselves that we're going to have something sustainable, and the risk reward isn't great. I mean, this report that you helped author in this Green Investing 2010 that's being released here, which I'd recommend everybody to read. I mean, it is great because it's very realistic. It says there's a lot that needs to happen because the risk reward, and it uses terms like that, are not yet good enough for private capital. So how does it get there? So it's admitting that, you know, private capital can't just do everything when something doesn't make a good return. And so it's just hard to wear that many hats.
Thank you very much for the plug for the report. I was going to give it at the end, and I will come back to it.
It's very good.
I will plug it too.
The team that put this together, the various agenda councils, sustainability and investing, have come together to write a report. I'm not sure if there are copies to be given out, but they are around over the next few days. I want to open it up to the audience. We have great panels, you can tell, very knowledgeable about different aspects of this problem. Richard, do you want to kick off for us?
Yeah, Richard Gledhill, PricewaterhouseCoopers. I mean, I think I share the analysis from many of the panel members about what happened in Copenhagen, but I'm still struggling in my mind as to how we bridge the gap between what is still proposed as a top-down approach for funding with a high-level panel and so on, with the bottom-up investment that needs to be made. And I'd like you to imagine for a minute that you are the high-level panel, Ban Ki-moon's panel. You know, what are you going to do to make this the deal flow accelerate and to get that 28 billion out into the market quickly?
Okay, Simon and James, probably. Let's take you in rapid fire on that one.
Well, I think Simon's already warned that there's a danger that some of the fast start money may turn out to be not that productive. But the first effort must be put into ensuring that you do the best you can to make it productive and ensure that the public money that flows is designed in part to facilitate private finance. And you know, that's in many parts of the world that's going to be extremely difficult to do. But if I'm sitting there, I'd like to at least try, because that money's already been pledged. The second thing is I'd like to look at ways in which you could combine the public and private finance relatively soon to provide some examples that people can follow. And I think, roughly speaking, there are three ways to do that. The first is to use the public money to create funds, sub-funds of the type that we have heard about from Uday and others, that enable you to be clear about where the money is situated, who's managing it, how much do they know about the place in which it's going to go, can they be trusted as distributors of the fund. And there are several productive conversations happening with multilateral development banks as well to enable some of the risk associated with investment, especially in the developing world, to be brought down with risk transfer strategies. So you could combine fund with risk management devices that make it more likely that private capital will go there and then be properly managed out. And then the third area, which I think is productive and requires serious analytical work first, but it's, I think, quite close at hand, and I might be even closer at hand within the high savings economies in Asia, is bond structures. So I would like to see this effort to organize multilateral finance and indeed some expertise around creating bond instruments, especially in the Asian economies. I think China is a particularly good place to do this, where you could bring capital to the market from the high savings cultures and spend that money. It would be very good for global financial rebalancing as well. Spend that money in their place, in their economy, achieving a global public benefit by building out clean infrastructure at scale.
Simon,
I'll take those three to start with.
Do you want to add to that?
Yeah, I mean, I want to reinforce the third, because I think it comes back to this issue of how do we move beyond the institutional investors in the US, UK, New Zealand, and Australia, to come back to the earlier point. You know, if we can't access Asian and hopefully Middle Eastern money, I don't know where we go here, however large you are in California. And secondly, despite the importance, and I take the point quite well, that one one deals with the issues in the US and China as major emitters and major growth emitters, particularly in the case of China. I do think that a more distributed set of experiments in different countries, even where the numbers appear reasonably small, are an important part of the parcel, whether it be in South Africa or elsewhere. I think building initiatives on the ground, using the bulk of that money to experiment in how to build, whether they be challenge funds or trust funds that blend public and private money, is going to be absolutely key. I would say that if those funds are not, in key instances, tied into a broader public policy frame about how low carbon economics and competitiveness goes forward, what we may achieve are interesting individual investments or even packages of investment, but actually quite problematic dysfunction at a national level, which will then start impacting on trade policy and a whole bunch of other stuff that we haven't talked about. And so the Fast Start funds need to leverage private money, but actually that might be done most effectively through policy integration at the national level.
Okay. We've got another question, gentleman at the back.
Steve Lennon from ESCOM South Africa, and I couldn't resist commenting on some of the points that Simon made, and I'd be careful about writing off the role of feed-in tariffs to create a decent investment environment for renewables. And I mean, in the South African case, yes, it's taking a hell of a lot longer than we would have liked to actually get that one off the ground, but I would anticipate that by the end of March, we'll have a feed-in tariff that will be blended in with a lower base electricity tariff, which really means that your electricity consumers are funding then your investments in renewables. And I have no doubt that that's going to work. And I think that we'll be seeing in South Africa over the next 2 years or so, we'll be seeing significant private sector investments in renewables on the back of this feed-in tariff. We'll also be seeing some big anchor renewable projects that are going to be funded with a blend of government-backed funding, which is funding that comes into ESCOM, as well as funding from the World Bank. And I think that I'd be interested in the panel's perspective on the role of DFIs in providing different blends of funds. So in ESCOM's case, we anticipate getting commercial funding as well as clean technology funding facilitated by the bank, and that will enable us to make considerable investments in large-scale renewables. So I think the bottom line is that, yes, the funding challenges are there, but the money is available. I think also the Fast Start money, I would anticipate that money is going to help utilities like ours to buy down the risk of investing in large-scale power plants with technologies that haven't had sort of 10 years worth of proving themselves, which is the way we normally do it. Thanks.
Michael, I think you need to, Judge, again, replug the report a bit, because I think one of the strong...
I will.
Because it does have a granular presentation of these incentives around the tariffs and everything that is very effective. Yeah.
Thank you. I will at the end. Question, there's a gentleman at the back, and then Uday here at the front.
Alan Barton, Lehigh Technologies. You painted a very bleak picture of the role of governments in terms of bringing some sanity to this problem. Do you think, on the contrary, they can end up making things worse just by wanting to appear to do something?
Ken, that sounds like a question for you.
They absolutely. If you distort markets, then it's not sustainable, and you can create more problems because capital gets wasted. And in a capital-tight world, which we're all in right now, we don't have that luxury. Yeah. So I think the key thing is do what works. And if you're going to experiment, that's fine. You can experiment with small amounts of money, but I think the government has to be very, very careful not to mismatch incentives with outcomes.
Mike,
yes, certainly, Jake.
Beg just a small introduction, because I think we've got to be straight about markets. The energy markets are massively regulated. They've been subsidized and directed and oriented towards the public good for so long. We can't make this. There is no pure energy market to invest in. You obviously know that. You probably do very well investing around public policy changes and shifts in regulatory and tax structures. So we don't have a pure market to go into, and we have a public policy problem we've got to address. So let's not pretend there's a nice instant pure market solution to this when there's not. It's also true that, and maybe it's a partial answer to Richard's question, given this huge challenge we've got to organise some better relationship between public and private finance, that we have got something, a fledgling carbon market that we could work with if we only built it to scale. And one of the fund ideas you could work with this is to find public money, including development bank money, to be, like, if you like, the big public policy off-taker of carbon, to encourage people to develop projects, specifically in the developing world, and know that they've got a reliable and stable price to work up for years to come. We haven't got that yet, but it's not that far away. You've got the infrastructure is really not that far away. You could build a fund largely with public money, which you could put private money into, that provided better certainty in a carbon price past 2012 that you can invest against.
Can we do the following now? We've got some more questions. I want to take, let's say, 2 or 3 questions, but very quick ones, 10, 15 seconds, questions. And then what I'll do, instead of having the panel answer them directly, I'll ask them for a closing thought each, in which they will try and touch on those 3 questions. So, Uday, you've got one, gentleman on the left, and I'm sure one from somewhere over on this side of the room.
My question's directed to my compatriot, Mr. Tanti. In developing countries, local corporate actors are going to fundamentally transform these environments, as Suzlon has already done. So therefore, if there's northern subsidy, we should also be thinking about how best it can help actors like you in bridging the economic risk-return gap. And my question is, what would be the most effective, if there was a pot of money that could help you by either increasing feed-in tariff, by giving you cheaper debt, by providing infrastructure funds to invest in the propco side of your business as opposed to the opco, but it's a limited pool. What do you think is the most efficient way that that money can help you scale sector by sector, wind, energy, solar, to really build that new vision?
Okay, because we're very limited on time, so let's get a couple of the questions and then we'll try and wrap them into the...
Rob Steele from the International Standards Organization. If I look at IEA statistics, in the past and into the future, energy efficiency is by far the most effective way of holding back increase in energy. And it seems to me that one of the key issues is actually an asymmetry in actually knowledge. I'd be interested in the panel's views about any macroeconomic views about how you might encourage the transfer of that knowledge, particularly around energy efficiency, north-south or between developed and developing countries.
Okay. And then final question. Oh, sorry, Mindy, we missed you. But
Thanks. This is Bill Gross from eSolar. My question is there any kind of analogy to like a Moody's or some metric for evaluating energy projects that could look at them scientifically or for an engineering basis to enable project finance to make these projects to go forward better, so that there could be a better way to evaluate the risk on these energy projects?
Okay, so a question there about specific mechanisms directed to Tanti in India, but I suspect of general interest. Standards, knowledge sharing, perhaps comes back to the softer reasons why energy efficiency is not happening, and then the role of risk management tools and potentially of information providers in that place. So let's start, Tanti, if we can start at this end, because there was a specific question to you, and then we'll keep it quick with a summary thought for each person.
It's important is there in a developing country like India and China and Brazil and Russia. I think the most important part to bring the more and more energy but efficient way development. The key success is very clear is the government policy framework and regulatory supports and legal frameworks. If that will be available and very long-term visibility is there, I think liquidity is available within the domestic market and it will flow from externally. The same time, these countries are catalysts to bring the low cost of the technology, and that is making a more commercial viable projects without any fiscal benefit. This project is competitive in this market. So that is the beauty of that. One part of the world is the same technology, 3 million per megawatt is there, where other part is the 500,000 per megawatt is there. So that's the huge difference of the investment is there. Because one part is giving a huge subsidy, other part doesn't have a subsidy. So that's why it is a market-driven technology, and that's efficiencies is bringing in particular in a developing country, which we can mobilize to the other part of the world.
And it's happening anyway.
Yes.
Ken.
I'll talk about energy efficiency because I'm a big fan of that. I think that, and to share the knowledge and to make it happen, number one is remove the burdens. It is so cumbersome at local levels. We mentioned properties. There are so many burdens to doing the right thing. The second thing is correct pricing mechanisms. It is so much more expensive to produce electricity for a consumer at 4 o'clock on an August afternoon in Texas than it is at 4 a.m., but yet they're priced identically. Okay, so if you make the pricing reflect the cost of delivery, all in, full cycle, consumers are amazing animals, and they will change their behaviors.
Change of attitude.
Very good. Jack.
Just where we started with Copenhagen, I think investors still at the top of our to-do list is policy clarity, getting it done, whether on a nation-state basis or on a global treaty. Ultimately, having that clear direction around policy is what's going to really accelerate investments from institutional investors. Secondly, we have to do a much better job with our asset managers on the analysis they're doing and incorporating climate risk and ordering their performance in tune with our long-term strategies. And thirdly, we need to clearly begin some diversification of how we've been investing these funds, since it's really been just on a subset of opportunities in the climate change area.
James.
Well, I'll pick up the knowledge and standards point in this way. First of all, this year's World Watch Institute State of the World report, for the first time, focuses on culture. And I think it's smart to see what it is that gets in the way of producing a better and more rational management of our natural resources, including the climate issue. And much of that is to do with knowledge and knowledge sharing and perceptions and all sorts of things that are very difficult to measure very precisely in the way that we generally do with economic matters. But equally, one of the things that features in that report is a discussion about choice and how it's perfectly acceptable to limit choice for public good reasons. And one of the ways you can do that with standards. So you shouldn't have available to you the possibility of buying something which ultimately damages you. And I think that the way in which one could take a lot of the problem away through proper standardization of white goods and various other things is that these markets grow around standards really very quickly, provided you're clear and authoritative about them. I think there's a big chunk of this problem that can be dealt with just by simple forms of regulation and standard and boundaries for choices that consumers make, provided you have a good open discussion about why and what the consequences are.
Simon?
Great. Yeah, so I'm going to link to the question from the back as well about can governments do harm without getting into an ideological war about it. In this case, northern money can do harm. There's no doubt about it. And we see in the development industry over 5 decades that it's created a rentier class in many countries in the world, institutional destruction and corruption. And so the first thing that northern money mustn't do is reinforce or create another rentier class. And we see the danger of that in CDM, in a number of countries. So that's what it mustn't do under any circumstances. What it must do, and I think it reflects what's already been said, it needs to invest in national level and local level innovation, different ways of building public-private partnerships, different financing structures, different ways of engaging different players. That has to happen at the national level, not at the international level. That won't help. Secondly, it has to invest in the policy space. And I don't think that's the traditional UN capacity building around policy. I think that will either be unhelpful or destructive. We can focus on a few specific things. For example, the removal of subsidies, how we manage the whole subsidies area, which we haven't talked about at all. And thirdly, and it comes back to a question you asked right at the beginning, which is northern money has to invest in adaptation. There's a sort of a quip saying that those in the climate space have heard many times, which is mitigation is the best way to deal with adaptation. Actually, it's the other way around. That if we don't deal with adaptation, no one's going to have any bandwidth to deal with mitigation. Okay. There's going to be no political interest at all.
I'm going to have to cut you off there, and it's great because James, having been called part of the rentier, the new carbon rentier, is dying to get back in. It's a fabulous place to break off because, as you can see from the slide behind me, the conversation continues on this thing called welcome which some of you may have visited and many of you probably haven't. And the aim of this is to be able to continue that debate. I'm afraid I shortchanged the audience a little bit in the questions because we were having a good debate up here and enjoying it, I think. But you can continue online, and I hope you do that. I also want to give a final plug for the report, which actually comes out tomorrow. There'll be a press release, and so you'll be able to pick it up tomorrow. Some of the members of the expert committee have actually got early copies. What we actually did in that report, so that's New Energy Finance, working with and for the World Economic Forum, is to look at, first of all, an update on what is happening in finance. There's an enormous amount that is happening. There's $150 billion worth happening, which is not nothing, and it is funding all of the, of Tanti's projects, and Ken is investing it, and it's Jack's money, and so on. So there's a lot happening. That's the first part of the report. But the second part of the report says, look, there's still a lot to be done on the policy side, and sometimes those policy debates break down into, I like feed-in tariffs, well, I like R&D grants. And the point is that these technologies have to go through a complete baton race, a relay race. You need early-stage technologies, you need to scale them up, you need to get them out there at larger and larger scales, they need to go into the developing world, they need to become mainstream, and so on. And different policies work at different stages and in different countries. We've taken 35 different policies that look at how you form equity and how you encourage debt, and using the tax code and using funds and using the carbon markets to do all of that. And I do think it's a good systematic look and an attempt to spur more discussion on the boundary conditions which make it not just safe to invest, but also remunerative, to give the rewards for investment as we go into a low-carbon future. So I'm afraid we're a little bit late. I do apologize. I hope you felt it's worthwhile, and I'd like to thank our panelists and audience.